Hey everyone, Ariane here from Axe Options. If you're a part of our room, you know that we've been using an options trading strategy that has been successful 92% year to date, that has a 200+% return on our investment and continues to make our traders a weekly income. So the credit spread is an advanced trading strategy that we use at least 3 times a week on the ticker SPX. And so I thought I'd make the following video to explain kind of in detail what the credit spread is and how it reaches its profit potential. And hopefully you can master the strategy because this can be used for other tickers and in different time durations. So if you have any questions, let me know. Okay, so let's just start by defining what a credit spread is. A credit spread is an option strategy that consists of 2 legs. You're selling an option, and then you're buying another option with the same expiration date but further out of the money. So there's 2 types of credit spreads. A call credit spread, which is also known as a bear call spread, where you're selling a call and then buying another call at a higher strike price but with the same expiration date. And a put credit spread is the opposite, and it's called a bull put spread. So when you expect the stock to move lower, you're buying a bear call spread. And when you expect the stock to move higher, you're putting on a put credit spread. Okay, really quickly, if you're a current member of our room, these types of spreads are alerted in the 0 DTE trade channel. Okay, so I've put up an example trade here, and every trade will have 2 strike prices. So you can see 27.55 and then a further out of the money strike, which is the 27.50. Every trade will have an expiration date, which you can find in the middle of the options chain. And since it's a put, we're always going to be on the right-hand side of the options chain. And then in Thinkorswim, you can see that they have put an icon next to which of the strikes you're selling and which of the ones you're buying. So this example is a bull put spread, and we would want SPX to move higher. So the further away from the at-the-money strike, which in this image is 28.10, the further away our strikes move from 28.10, the lesser the premium is worth. And for our max gain, we would like for it to be worth nothing. Okay, so how do we profit? Let's do the math. Okay, so in this screenshot, selling the 27.55 strike would give you $1.85 in credit, and buying the 27.50 strike would cost you $1.45. So the net credit on this spread would be 40 cents. But we typically aim for at least 50. So going forward, I'm just going to use the example that we filled at 50 cents. So for every 1 contract, that controls 100 shares. So the max gain for every 1 spread would be at least $50. Okay, so let's calculate what the max loss is, because this is also the margin requirement that your broker will require of you. So SPX trades in $5 increments. So you take the width of the strikes and you minus the credit you took in, which was 50 cents, and that leaves you with $4.50. And of course, you times that by 100, so the margin requirement will be $450 for every 1 contract. Okay, you might be asking yourself, why would we take a trade where we are risking $450 to make $50? And the answer is it has a high probability of success. And I can actually show you how high the probability is. Thinkorswim has a column, which is cut off in my image, but it's called probability out of the money. And this spread has a 90 to 92% likelihood of expiring out of the money, which also means worthless, which is our max gain. Okay, so in addition to having a high probability of success, this strategy also has a great return on your investment. Let's do the simple math, where if we took in $50 of profit for using $450 of our capital, that's an 11% return. And we typically do these in 1 trading day. So to get an 11% return in 1 trading day is pretty good. Okay, let's talk about what happens if the stock does not move in our direction. Okay, so this is the chart of the entire day's price action for SPX on the day that we traded that previous example. So we entered the spread at probably 10 or 15 minutes after the bell. And you can see on the right-hand side where the prices of SPX, and that it was trading at about 28.10. Since we put on a put spread We are bullish on SPX, and all we need is for it to close above the higher of our two strikes. So long as SPX closes above 27.55, we will be at our max gain. So if SPX were to move down during the day, we would need to consider cutting the trade if it got near one of our strike prices. So it's hard to make a blanket statement about where or when we would cut the trade, because every day we're watching different indicators and watching new support and resistance levels as the stock trades throughout the day. So generally we would consider a stop at 2 to 3 times the credit received. So if the premium reached $1 or $1.50, we may have to consider cutting the trade. Okay, something that I thought was worth mentioning here is the benefit of selling a spread versus buying a single call or put. So if we were still bullish on SPX and we had entered a call option for SPX at 28.10, SPX would have had to have moved up for us to have made a single penny of profit. But in the event of our spread, SPX could have moved up, which would have been in our favor. It could have even traded sideways all day, and it still would have been profitable for us. And it could have even had quite a significant move down, just so long as it did not go below 27.55. And in all three of those circumstances, we still would have profited. Just to recap here, if at the beginning of the day you are bearish on the ticker, you put in a call credit spread. And if you're bullish, you put on a put credit spread. You want the spread to expire worthless, which would be your max gain. Okay, so for the past couple of months, we've been suggesting to our members that we close the trade at 10 cents, and I'll show you why. If you look at the price action of the last hour's worth of candles in this image, you can see that it was wildly swinging, 40 points up and down. And had we been in a spread, it would have severely challenged. It doesn't even matter what side of SPX you were on, a bull put spread or a bear call spread, it would have challenged our position. So it's just been our experience so far this year in 2020 that less time in the trade is better for our stress levels, and it's just a way to mitigate our risk. So we've been closing the orders at 10 cents. So while there are pros to exiting the trade at 10 cents, there's also some cons. You will lose a day trade because you're making a round trip. So you're buying and selling within the same day, and you will be losing $10 per contract. And you'll also have to pay commission on the closing order versus had you just let it expire worthless, you simply leave it alone and the broker takes care of closing out the trade. In case you're wondering why, if we are making a directional bet, wouldn't we just sell the 27.55 strike and keep the entire $1.85 credit without buying the 27.50 at $1.45? And the answer is the margin requirement, because theoretically SPX could drop to zero, right? And the margin requirement would be 27.55 times 100. So putting on a naked put would have quite a bit of risk. And on the opposite side, if you were on the call side, SPX could rise theoretically infinitely. So the margin required would be extremely high. So that's why we put on the second leg as sort of an insurance or hedge against the first call. And doing so also defines our max gain and our max risk. Hey everyone, so a couple more things that I just wanted to say about this strategy in closing is that we typically trade 0 days till expiration credit spreads. So we enter the trade pretty early in the morning, and that's in order to capture the morning volatility right after the bell. So it's important to be ready early in the morning to jump into this trade and capture those higher premiums. The other thing that I wanted to say is that even though you've seen that this strategy has a very high percentage of success, the losses, if you let them go to max loss, can be devastating. They can wipe out several prior weeks of gains. So as a trader, it's important to know when to cut your losses. Also, the goal here is small, consistent wins over time. Consistency, not huge winners. So keep your contract sizing comfortable, okay? Because if and when there comes a time when your position is going to be challenged, this will immediately turn into a very high stress trade, and you might make a decision you wouldn't otherwise make had your contract sizes been smaller. So part of being a professional trader is knowing that nothing in the market is guaranteed, and that there will be a time when you're going to have to make a tough decision about whether or not to cut a loss or to cut a trade. So having losses are part of this game, so you have to learn to keep them small, lose well, and know that there's another trade around the corner. Also, and lastly, in case you were wondering why we put in a close order for 10 cents and not 5 cents, in my experience, those 5-cent orders do fill, but they often take an additional couple of hours. And in this strategy, sometimes, especially towards the end of the day, time equals risk for this strategy. So it's just been in my experience that a 10-cent order is easier to fill than a 5-cent closing one. All right, everyone. Thanks for watching. If you have any questions, please feel free to ask me. Thanks. Bye-bye.